The Rebel Capitalist Show.
I want to go back to just kind of the Fed having their hand on the scale, if that's the right way to say it, or the Fed really being active in, let's say, money markets. I know there's a lot of information that we can get from the yield curve, and especially when it starts to flatten and when it inverts, there's an extremely high probability that we go into a recession. But if the Fed is involved in the bond market, the Treasury market, to the degree to which they are, how much weight should we give the flattening of the yield curve now? I guess that's my best question.
Yeah, good question. Well, let's define terms. So what is a yield curve? It's simply the spectrum of interest rates over time. So it stretches from zero, which is like this instant, to 30 years. And typically, bonds maturing later, longer dated securities have a higher yield because of the typical human preference for something available now rather than having to wait. So the impatience of the ordinary human being accounts for the conventional shape of the yield curve, meaning again, that a 30-year bond yields more than a 30-day Treasury bill. That's the way typically it works. So enter the Fed. So the Fed now has control, typically pretty good control over the very, very short term. There's less control over the 2 to 5 year period. There's influence there, but not direct control. It has a rhetorical control. It tells you what to think. It primes the market by setting expectations. And so there's a little bit of a psychological game going on at longer days, but it has very little direct control over 30 years. Okay, except for setting expectations of its own policy. What is happening now is that the difference between 2-year yields and 10-year yields has been very narrow. Now, that's not strictly the definition of a yield curve as I take it, as an inflation signaling, a recession signaling, or a boom signaling phenomenon. I think the better space of the yield curve to examine is that between the 30-day or 90-day bill rate versus the 10-year Treasury note. So the 10-year Treasury note is now not quite 2%. The 90-day bill rate is much less. So the yield curve is not close to being flat there, but it is close to being flat 2 years to 10 years. And some people look at 2 years to 10 years. So what is different today? Well, one thing is that the flattening from 2 to 10 is taking place before the Fed even starts its projected cycle of raising interest rates. Never before seen. This is a very new thing.
I didn't know that.
What is a little bit different also about today is that there's a lot of leverage or debt in corporate America. Families are better financed than they were in 2006 and 7. But corporations and the government itself, leave the government itself aside for a second, but there's a lot of debt in the corporate world, a lot of private equity transactions that have entailed a whole lot of leverage, leverage being a Wall Street term for encumbrance or debt. So the question is, as we look at interest rates now beginning to rise and the yield curve beginning to flatten by some measures, and you say, well, what does that mean? Well, it might mean that the economy has so much debt that even a measured or a nominal rise in yields would put pressure on companies that owe money, and they would have to take steps to repay debt. They'd have to fire people, cut back production, do things to hunker down and sell division. So the fear, I think, is that the combination of the visible debt in the economy, the combination of that plus the visible flattening at some portions of the yield curve, and the intrusion of very high rates of inflation, all these three things are setting up for what we used to call stagflation in the 70s. Stagflation being, of course, the state of recession overlaid on inflation. Keynesian once said that was unlikely or impossible, but it did happen way back when. And I guess it could happen again.
So why are we not seeing a steepening at the long end? I mean, I mean, maybe does it have something to do with the going out the risk curve, like we were talking earlier, from the standpoint of investors now might not buy treasuries for yield. They might buy treasuries for capital gains.
Yeah.
And do you think that may play into it?
Well, I think that the bulls on bonds would say this. I think they would say that of course, these securities are denominated in dollars, and in time of geopolitical tension or war,
Right.
what is dollar bills, and that the Treasury market is the beneficiary, that foreign demand for treasuries, as we speak, has slightly strengthened. And they would say further that observe over the past dozen or more years that when the Fed moved to raise its funds rate, this little tiny overnight interest rate, that the longer dated portion of the Treasury market did not go up in yield, but rather stayed where it was or even rallied because people thought, well, now the economy really can't handle higher interest rates for the reasons that I've been trying to explain. And I think there's another thing, which is pure muscle memory. Interest rates have been falling since 1981.
Right.
So that's 41 years. And you have to be even older than I am, George. If that's conceivable. A successful Wall Street career is like 25 years. If you're any good at all, you're playing golf in Boca Raton at the end of 20 years. So you could have 1.5 Wall Street careers and never have seen a bond bear market. Right. So people, and I can tell you because I was around in the last time we had a bond bear market, that when that came to an end in 1981, people were still scoffing at it through the 1980s. Interest rates can't go down.
Right.
And the most intriguing portion of that particular phase of our history that I can recall is something that happened in 1984. And this is a little bit instructive on the question of muscle memory. So I'm talking now about the 30-year Treasury, and that yield peaked out in the fall of 1981 at 15%, if you can imagine, 15% on 30-year Treasury bond. So that was about the time that Reagan had broke the air traffic controllers union, commodity prices broke, and it seemed as if this long cycle of inflation, thanks in part to Paul Volcker's very brutal monetary policy, was in the rear view mirror. But just go forward 3 years, 1984, and money growth was kind of percolating, and Milton Friedman and Henry Kaufman were saying, and those are two great thought leaders at the time, were saying, well, this interest rate's going right back up again, and they're going to go higher than they did before because of like money growth. And in the spring of 1984, interest rates got to, again, in the 30-year bond, got to 14%. So that's how tenacious was the psychological hold on people that the interest rates are meant to go up.
Right.
It was almost, that can't go down, right? And we know that. They have been going up since 1946. Well, that was only 35 years of a bond bear market. We've had a bond bull market for now, call it 42 years. Historians might now date it like 3 years ago when yields got to below 1%, but interest rates at least have been going down or sideways for 41 years, and people are kind of a mindset they are meant to continue to go down or sideways.
Yeah. So from 46 to 81, that was the last cycle. Is that correct?
That was the last bear market in bonds, yes.
So
Yeah.
what do you think triggered that, or what was there just one catalyst, or was it multiple things? And
Well, you look back at, yeah.
How would you learn from that to try to determine what a catalyst may be today?
Yeah. Well, when you look back on it, the catalyst was the employment act of 1946. And signed legislation saying that the United States was responsible, the government was responsible for a state of high employment and economic stability. So that was the institution of Keynesian doctrine into federal law. And you think, oh, yeah, of course, that was it. But that was not exactly it. In that, when about the time that Truman signed this, I'm just going from memory, the long bond yield was 2.25, 2.12, I guess that was the bottom, 2.12, about where the 10-year has been recently. And I can remember I did some, I actually lived through it. I was very young. I was only one. Well, my mother told me, George. But it took 10 years for that 2.25% long dated bond yield to get to 3.25.
Huh. Yeah. Right.
Not until 1956 or so was that first 100 basis points, first 1 percentage point of that move higher. What happened was the catalyst was something we see again, as they say now, in the rear view, but you don't know at the time. And to me, the catalysts to me are almost innumerable now. I mean,
right.
What's wrong with these people? You got the Fed printing the $6 trillion in the past. M2 is up 40% in the past 2 years. The federal deficit blowout. All these crazy ideas. Everyone's toying with or actually advocating so-called modern monetary theory. The whole world's crazy, if you ask me, George.
Yeah, but it seems like that muscle memory that you were referring to earlier makes interest rate cycles almost like that quote about going bankrupt. It happens very, very slowly, and then all of a sudden, to your point, in 46, it takes 10 years.
Interest rates are so funny in that respect. I can't think of any other department of finance that exhibits these long cycles, but and I'm not sure that they're a matter of physics. I'm not sure it's hard and fast. It's a law, capital L. But since the U.S. Civil War, from like 1865, 1900, interest rates fell. From 1900, 1920 or so, they rose. 2046, they fell. And then they rose from 1946 to 81, and they have fallen for the past 41 years. So in each of these cycles, people became acclimated. 20 years is a long time to watch something and not develop the notion that it's meant to be, right, for all time. So that's the peculiar and intriguing nature of race. I've thought about this for a long time. I don't know what called. You can kind of overlay to a degree. You can kind of imagine that monetary regimes might explain it, but I don't know. I leave it as a mystery, but something to know has happened, and to be wary of those who contend now that, oh yes, interest rates fall. That's what they do for a living.
Yeah.
Interest rates fall.